What if the loudest political battles you see on television are only distractions, while the real decisions are being made quietly with trillions of dollars far from public view? While politicians argue, markets move, and history shows that this pattern never lies. Between 2018 and 2020, the United States appeared to be locked in a historic confrontation with China. Tariffs were imposed on hundreds of billions of dollars worth of Chinese goods. Headlines talked about standing up to Beijing, protecting American workers, and bringing manufacturing back home. Both political parties seemed united in the message that America was finally going to push back. Yet, during those exact same years, something very different happened behind the scenes. Major Wall Street institutions quietly moved around $1.4 trillion into Chinese markets. Not over decades, not slowly, but during the peak of the trade war itself, with 2020 marking the highest level of inflows. This was not bad timing or confusion about politics. It was one of the most predictable moves in modern financial history. To understand why, you need to see the pattern. For more than 300 years, every major reserve currency has followed the same four-stage mechanism. The global financial system is not random or chaotic. It operates according to incentives that repeat across centuries. First, a monopoly on money creation is established through a central bank. Second, that monopoly is used to finance government expansion through debt. The economy grows, the empire expands, and confidence is high. Third, the system overextends. Debt rises faster than productivity, the currency starts losing value, and cracks begin to appear. Finally, in the fourth stage, the same financial elites who built the system quietly move their capital into the next rising power before collapse becomes obvious to the general population. We have seen this before, in Britain, in Germany, and in the United States itself. In late 17th century Britain, war and debt pushed the government to create the Bank of England. The bank loaned money to the government and gained the power to turn government debt into circulating currency. National debt exploded, but the system appeared to work. Britain built the world's most powerful navy, expanded across the globe, and made the pound the dominant reserve currency. International trade ran on British money, and foreign governments held pounds as reserves. But by the mid-19th century, the cracks appeared. Industrial dominance shifted toward Germany and America. The cost of maintaining a global empire grew faster than Britain could afford. Debt climbed again. Quietly, British capital began flowing into American railroads, steel, and industry. By the time Britain abandoned the gold standard in 1931 and the pound lost its reserve status, the system had already been rebuilt in New York. The money moved before the collapse. After World War I, Germany followed the same path in a more extreme form. Burdened with massive reparations, the government chose to print money rather than raise taxes. The central bank monetized government debt at an enormous scale. Hyperinflation wiped out savings, destroyed the middle class, and destabilized society. What is rarely emphasized is that this outcome served powerful interests. Domestic debts were erased, and political obstacles were removed. When stabilization came, it required foreign loans, primarily from American banks. Wall Street entered during the crisis, restructured the system, and exited before the political disaster fully unfolded. Again, the pattern held. After World War II, the United States created the Bretton Woods system, placing the dollar at the center of the global economy and tying it to gold. For 2 decades, the system worked. Europe and Japan rebuilt, and American economic dominance was unmatched. But over time, the United States used its reserve currency status to finance wars and large social programs without raising taxes. Dollars flooded the world. By 1971, there were far more dollars in circulation than gold to back them. Foreign governments noticed and began demanding gold. In August of that year, the United States closed the gold window. The dollar became a fiat currency, backed only by confidence and power. Since then, it has lost over 98% of its value against gold. Now apply this same framework to the present. In July 2018, the United States imposed its first major tariffs on Chinese goods, marking the official start of the trade war. But just 1 month earlier, global index providers began including Chinese stocks in major investment indices. That decision forced institutional investors around the world to allocate capital to China. Pension funds, insurance companies, and sovereign wealth funds followed the index. China's weight in global portfolios surged, and between 2018 and 2020, American portfolio investment into China reached approximately $1.4 trillion. At the same time, U.S. national debt climbed toward $36 trillion. The Federal Reserve's balance sheet expanded dramatically, following the same debt monetization mechanism seen throughout history. The system entered the late stages of overextension. This is why the trade war was never about stopping China. You cannot fight a rising power with tariffs while your largest financial institutions are building its markets. You cannot bring manufacturing home while the architecture of global capital allocation is directing trillions elsewhere. The contradiction is not a failure. It is the mechanism working exactly as designed. The population is shown political theater, while capital quietly repositions. This happened in Britain. It happened in Germany. It happened during the collapse of Bretton Woods. And it is happening again now. By the time these transitions become obvious to the mainstream, the repositioning is already complete. Inflation is not temporary. Currency debasement is not accidental. And this time is not different. Holding assets denominated entirely in a weakening currency is a choice, whether people realize it or not. History does not require belief. It executes regardless. The next decade will not resemble the last 30 years. The debt cannot be repaid in real terms. The currency will continue to lose purchasing power. Financial elites are already positioned for what comes next. The only real question is whether you recognize the pattern while it is still unfolding. If you want to understand how this system was built, how it actually operates, and what the final stage looks like before it fully arrives, subscribe and stay connected. Unlike every cycle before, you have the opportunity to see the pattern in real time, not after the collapse is complete.